In this video, we're going to be discussing a very interesting hidden tax that you seem to be paying on all assets. And I've decided to dub this the Gainflation tax, and you'll see what I mean when I get into it. So, did you know that inflation and capital gains tax come together in a sneaky way to tax your assets, even when you've made no gains? And this is effectively taxing your attempts to avoid inflation. So let's just go back over what capital gains tax is. So capital gains tax is a tax you pay when you sell an asset at a price higher than what you bought it for. So it's the difference between the buy and the sell price that determines the gain. So we refer to this as the gain. So the example I always like to go back to is if you buy a house for $100,000 and then you sell it for $130,000, then the gain is $30,000. And that's now subject to capital gains tax. So depending on where you live and various factors, you'll be subject to a different rate of capital gains tax. But let's just take it to be 33% for this video. So in the case of that $30,000 gain, you're now going to owe $10,000 of your profits to the government. So that's precisely how capital gains tax works. Now the problem with this is that capital gains tax does not take inflation into account. It's actually quite possible that you didn't even make any profit on that house in real terms. So for example, if the inflation rate was consistently at 6% per year, so we're imagining maybe not the best economy at the moment, and you held onto that house for 5 years, this means that the $130,000 you have now has the same purchasing power as $100,000 did 5 years ago. So the government has thus effectively charged you a $10,000 fee for just holding onto an asset, and that's due to the inflation in the fiat monetary system. This is putting you in a worse financial situation than before. So now you can see why I've decided to call this the Gainflation tax, and that's a play on the words gain and inflation. So if you just combine those, you get Gainflation. So now it would actually be interesting to generalize the fee paid and actually compare that to other figures, for example property tax. So we can generalize the annual fee paid by multiplying the capital gains tax rate and the inflation rate together. So in the case where we had a 33% capital gains tax and a 6% annual inflation rate, then multiplying those together comes out at 2% annually. So what this means is you are paying a 2% tax on all assets you hold every year. And this can be in a sense thought of as an extension to property tax in the case of houses. So this applies even if you've made no gains in real terms, and then if you've made gains as well, there'll then be the additional capital gains tax on top of this. So it's quite a lot, and in a sense it can be thought of as an extension to the property tax. So in many areas, this Gainflation tax rate is upwards of 10 times higher than property tax, making property tax quite negligible in comparison. This is something you might not have ever even been aware of. Now, fortunately, this tax isn't due until all your assets are sold, as opposed to property tax, which is due at frequent discrete intervals. But nonetheless, that doesn't really reduce the significance of the tax, it's just a matter of when that tax is getting paid. So it's a matter maybe of your credit position, but not your overall burden. So this tax comes out to be quite a burden for asset holders, especially when we still suffer from inflation during times of supposed economic growth. In these times, the reference point used for capital gains tax is completely backwards in my opinion. So any frequent house movers have to constantly realise a loss, even if their new house is similar in value to the previous one. Similarly, anyone trying to hedge against inflation has to outperform the inflation rate by 50%, and that's if we're counteracting a capital gains tax of 33%. So what can we actually conclude from this? Well, what it means is that everyone suffers from inflation, not just those holding a deteriorating currency. So actually, if your currency is doing particularly bad at the moment, it's deteriorating a lot relative to other currencies, then the tax burden actually goes up. And this actually puts you in a worse economical situation. So it's quite interesting to consider the effects of this. What would happen, for example, if a currency starts performing very badly? Would there be kind of a ripple effect? Would the fact that the Gainflation tax that is being paid cause investors to be less keen to invest in this particular economy? And could that actually cause things to spiral out of control? Could that cause the currency to crash even further? Probably not, to be honest now, but that's just a little bit of speculation there. It's definitely something you could spend hours thinking about, seeing what are all the consequences of this. But to put it simply anyway, you are being taxed on your attempts to avoid inflation. So you are locked into the flaws of the fiat system no matter where you go. And look, that does kind of make sense. The fiat system is tied so strongly into the whole economy, and tied up directly with the government, whether it's in control directly or indirectly by the government. It all kind of works together in that way, and so it's kind of understandable that you are locked into the flaws of the fiat system. But I think it is quite an interesting observation that even when you attempt to leave a particular fiat system, even if it's another currency, for example, and with cryptocurrencies gaining traction at the moment and over many years now already, it is worth noting that you are due this gainflation tax no matter what. And that does emphasize the control and the influence, really, of the fiat system on our economy, and perhaps the lack of ability to easily kind of move away from that system. But for many other reasons, I think the capital gains tax is a very ineffective way of taxing anyway, because you're kind of incentivized to keep loads of business internal rather than, for example, constantly realizing profits through selling assets and buying other assets. So for example, if a large organization keeps all their business processes into one kind of large company, the tax burden is often less than if you have loads of parent companies and parent companies around that, and there's constant, it kind of incentivizes you to keep profit internal, because once you kind of realize it externally via trading, then suddenly this capital gains tax is due, and you're kind of incentivized to reduce the frequency at which you have to pay this capital gains tax. And of course, this is due to the exponential nature of profits. Due to the compounding effect of profits, if you do pay capital gains tax more often, then this will have a compounding negative impact on your overall profits. So you would be expected to have less kind of overall profit in the long run as a result of this. And there's other reasons as well that I think the capital gains tax system is not the best idea. But anyway, I think I've been rambling on too long for this video. So yeah, what do you think about all this? I'd love to hear your thoughts in the comments below. I think it's quite an interesting thing to think about. This idea that you're still getting taxed based on the inflation rate and the capital gains tax rate coming together. So thank you very much for watching, and I'll catch you again next time.